Tensions between the United States and Iran are not just political headlines. Whenever instability rises in the Middle East, oil prices react, financial markets become volatile, and inflation fears increase. A conflict thousands of kilometers away can influence petrol prices in India and stock markets worldwide. To understand this connection, we must look at history, energy, and economics together.
With this concession, we assure unprecedented prosperity
and secure our nation's future.
Your signature will seal this historic partnership.
It is done.
The roots of modern tensions go back to early oil agreements between Persia and British interests. Profits from Iranian oil largely benefited Western companies, creating resentment inside the country. When Prime Minister Mohammad Mossadegh nationalized oil in 1951, it challenged Western control. The 1953 coup reshaped Iran's politics, and the 1979 revolution transformed it into an Islamic republic, shaping the Iran we see today.
Oil, power, politics. From the British concessions of 1901 to the coup of the seizure of the embassy plunged two nations into decades of conflict, escalating through proxy wars.
Iran holds some of the world's largest oil and natural gas reserves. More importantly, it lies beside the Strait of Hormuz, a narrow sea route through which nearly 20% of global oil supply passes. Any disruption in this region can trigger immediate reactions in global energy markets. This strategic geography makes Iran economically critical to global trade and stability. Iran's influence extends beyond energy reserves. It has developed missile systems, advanced drones, and strong naval capabilities in the Persian Gulf. While it may not match Western military power directly, its ability to disrupt regional oil routes gives it strategic leverage. In geopolitics, control over supply chains can be as powerful as military strength. Energy markets respond quickly to geopolitical uncertainty. When tensions rise, benchmarks like Brent crude often experience sharp movements due to fears of supply disruption. Even a moderate rise in crude oil prices increases transportation and manufacturing costs worldwide. Since oil is a core input for many industries, price volatility spreads through the global economy. India imports nearly 85% of its crude oil needs. Therefore, rising global oil prices increase India's import bill and put pressure on inflation. Higher fuel costs affect transportation, logistics, and consumer goods pricing. Currency stability can also be influenced. Ultimately, these economic pressures reach households through higher daily expenses.
I can't believe this. How are we supposed to afford this now?
It just keeps going up. What are we going to do?
India imports nearly 85% of its crude oil needs. Therefore, rising global oil prices increase India's import bill and put pressure on inflation. Higher fuel costs affect transportation, logistics, and consumer goods pricing. Currency stability can also be influenced. Ultimately, these economic pressures reach households through higher daily expenses. Consider a scenario where crude oil rises from $80 to $100 per barrel. This 25% increase can translate into a 5 to 10 rupee rise per liter in petrol prices in India. For families consuming around 60 liters per month, that could mean an additional expense of 600 rupees monthly. This demonstrates how global events directly impact personal budgets. Geopolitical tension often increases market volatility. Indian indices such as Nifty 50 and Sensex may experience short-term corrections due to inflation and uncertainty. U.S. markets can also react similarly. However, certain sectors like energy, defense, and commodities may benefit during such periods, depending on the severity and duration of the crisis. During uncertainty, investors typically move towards safe haven assets. Gold and silver often attract higher demand in times of geopolitical stress. These precious metals are viewed as stores of value when markets appear unstable. Rising gold prices frequently reflect increased global fear and risk aversion among investors. For investors, discipline is essential during geopolitical uncertainty. Short-term volatility does not always translate into long-term damage. Maintaining diversification across equities, commodities, and fixed-income instruments helps manage risk. Rather than reacting emotionally, informed investors observe macroeconomic trends and stay committed to long-term financial goals. Disclaimer: I am not a SEBI-registered investment advisor. This video is created only for educational and informational purposes. Please do your own research before making any investment decisions. If necessary, consult a verified financial advisor.